Audio Jungle.
Good morning and welcome to KIID's presentation on how to build a fund portfolio. My name is Christian Kamazuli and I've been working in the industry for over 11 years now, 8 years of which has been with KIID. Way back, the markets were much more easy to interpret, whether it's buying a bond, whether it's buying an equity. Whatever you did, the potential for making money was much more easier than it is today. Not that today it isn't easy to make money, but the amount of study that needs to go into every investment obviously has increased. And we're here today to talk about funds because we believe at this level of the level at which the markets are trading at, you need someone professional to be taking care of your portfolio. And funds, with a fund manager there 24/7 debating on which markets should outperform and which assets should be invested in, is the best way to do this. What is a fund? First, before I'm going to tell you what a fund actually is, think of your portfolio, okay? So is your portfolio over-allocated to one industry, for example? If a bond had to default in your portfolio, would it hurt your total return? Okay, does your portfolio cater for your needs? Okay, and is the portfolio managed in a way that's going to benefit from the positive economic data that's coming out from the economy? If most of these questions cannot be answered because you're not monitoring these things, then a fund is good for you. Okay, why? Because a lot of people say, but if I don't have a lot of money in my bank account, if I don't have a lot of money with KIID or another broker, then people, okay, won't manage my portfolio, won't take care of my portfolio. When this is not actually true, because through these vehicles, through a fund, okay, there's a manager that is taking care of your investments. Okay, what type of investments make up a fund? Okay, now there are equity funds, okay, and there are bond funds. Now, again, what's an equity? Okay, an equity is a shareholding in a company. A lot of people have bonds in their portfolios. But just because you feel much more comfortable with a bond, and just because you feel you can take on the risk of a bond, doesn't mean you should shy away from equities, for example. Give the responsibility to someone that understands in the field, okay? And through a manager managing this fund, okay, you can get exposure to the equity market, which is very important, okay? Then there are what are also known as money market instruments. Now these are just three basic, okay, funds out there, and money market instruments are short-term liquidity funds. Okay, so if, for example, you have cash in your portfolio, you need that cash to remain liquid. Okay, you don't want risk on that cash, but you want to get some return from that. You put it in what is known as a money market fund, and then there are what is known as called as derivatives. And I put the word derivative there. I know it's a heavy word, but it's something which maybe you do not think of as well when you manage your own portfolio. Let's say you have an equity portfolio, okay? You have US stocks, you have European stocks, and you think the equity market across the board is doing well, okay? But do you factor in, for example, the currency movements in the portfolio through hedging derivatives, for example, or through what are known as future and forwards? You can eliminate, okay, the risk of the currency fluctuation in your portfolio. A lot of people might not do that, okay? But if you look at the euro-dollar today, and across the last 5 years, the strength we have seen in the dollar, okay, at this point in time, since you're based in euro, you would have benefit from that, okay? But even that is being managed when it comes to a fund, okay? So the fund manager looks at everything, many things which an individual investor, okay, doesn't look at. Okay, next question, who manages these funds? And like I've been saying, it's a fund manager, okay? And when we talk about fund manager, those are houses over there, well-known houses that actually are fund managers of funds. And it's important that you feel comfortable with the house you're investing in, okay? Because at the end of the day, although, as I will show you, although the responsibility of the decisions is taken by the fund manager, a lot of other risks are not borne by the house. But it's important that you feel comfortable with these fund managers. And you will see that out there's a lot of documentation and there's everything that you need in order to take an informed decision. Okay, and I'll be showing you all these documents in the slides ahead. Also, it's important that through these documents, you see who the fund managers are, for example, that are managing the funds you buy in your portfolio. And that they have enough expertise to be able to be managing these funds. But obviously, with the houses you've seen there, I have no doubt that the fund managers have this expertise. Who holds the assets of the fund? Now, this is a very crucial and important point, because a lot of people say, okay, I invest in a fund of KIID, but what happens if something happens to KIID? I invest in a fund of UBS, but what happens if something happens to UBS? And the thing is that the assets of the fund are not held by KIID. So you do not have the risk of KIID if something had to happen to KIID. Why? Because, for example, I am a manager on the Euro Equity Fund of KIID. When I place an order to buy a stock for the Euro Equity Fund, the instrument I buy is delivered directly to the custodian. Okay, so KIID does not hold the assets of the fund. Okay, it's the same with other funds. But then you may ask, for example, okay, KIID buys a fund and it's delivered to the custodian. Okay, the custodian is the entity that is taking care of the assets of the fund. Okay, what happens if something happens to the custodian? Even there, the assets of the fund are safe. Why? Because the assets of the fund, which are held at the custodian, are separate from the assets of the personal assets of the custodian. So if something had to happen to the custodian, still your assets are safe. Okay? So overall, and I think this is a crucial point because it's something that a lot of people are worried about. Okay? What happens to KIID? What happens to UBS? Well, nothing happens to you because the assets are not held by us, okay? The assets are held completely by another entity, which is the custodian, the person taking care of these assets. And again, I'd like to stress it and repeat it again, that even the custodian, the assets of the custodian, okay? It is not, if something happens to the custodian, your assets are still safe, okay? What does a fund structure look like? Now again, I'm going to put other players in the field, okay? Because again, people just look at KIID, look at the fund manager and say, but it's a black box, I don't know what's in the fund. And today I hope that when you leave this room, you understand that everything is transparent, everything is visible, whatever is in the fund, you will get to know, okay? And there's documents that show this. And there's no way that decisions aren't taken in the best interest of shareholders, okay? So like I've said before, there's the custodian who holds the assets of the fund, okay? And there's the fund manager that takes the investment decisions, okay? The investment manager is crucial. Why? Because his decisions will ultimately determine the performance of the fund. But then there is what is known as the fund administrator. Now, who is the fund administrator? Again, who determines the price of the fund? Okay, some people can say we come up with an equity fund, okay, KIID has a Euro Equity Fund, and every day we come up with a price. But let's say the market crashes, and maybe in your mind you would say, but maybe KIID would push up a bit the price or tweak prices so that the fund price would look even better and not reflect this. Why? Because it's KIID's fund and he can do this. Well, it's totally wrong. Why? Because the price of the fund has nothing to do with the fund manager, and it's coming from the fund administrator. Who is the fund administrator? In a simple term, they're like accountants, okay? What they do is they come up with the price of the fund. Okay, so again, the fund manager buys the assets, okay? They are delivered to the custodian, okay? Every day, because the Euro Equity Fund is a daily fund, okay? It is priced daily, okay? So when you come to buy a fund, the price is called the NAV. I'll go into greater detail in another slide. Okay, NAV is referred to as the net asset value. Okay, and that comes from the administrator. Okay, so basically what the administrator does, it gets the portfolio of the fund manager. Okay, it looks at the prices. Okay, costs are deducted. Okay, and the net asset value is the value of the fund. Okay, coming out from the fund administrator. Then the fund administrator sends an email to the fund manager and tells him, look, this is the price of the fund, do you agree? And the fund manager agrees or disagrees. 99.99%, we always agree. But again, it comes to show you that not even the price of the fund comes from the fund manager. So he cannot say, look, if, for example, today technology stocks are down 6%, okay, the fund manager cannot adjust prices, cannot do whatever he wants, because there's another entity taking care of that. So as you can see, okay? Shareholders' interests are always protected when it comes to funds. Something else I didn't say in a previous slide, which is very important. I mean, like I said today, asset prices are expensive, but still, we believe there is value in the market, okay? And we need to go into greater detail in order to be able to benefit from this. Because personally, I think, and I'll go through our house view stance later on in the presentation when we come to the market outlook. But although we still think there is room for the markets to run, there are pockets in the market where we think will outperform others. And even within those pockets, within those sectors, okay, we need to dig deeper into what we're buying. Okay, we do all that work. Okay, and it's important that this work is done in order to be able to benefit from this. Okay. So how regular does a fund trade? Now again, it's very important that when you buy a fund, okay, you buy a fund that either trades daily or trades weekly. Okay, because there are funds actually that trade monthly. Okay, but you don't want to take on a fund that actually trades monthly. If you look at our fund lists that are in your pack, okay, and I'll also go through them, so I'll explain exactly what makes up the fund list and for you to better understand the columns within the list, all the funds that are there are daily funds. Okay, we make sure that they trade daily. Why? Number one, it's from a liquidity point of view. If you want to get out of the fund, you can do so on a daily basis. Okay, but also if, for example, we see that the market is not going in a positive direction and it's time to be raising cash, okay, you can do so on a daily basis. Why? Because if it is a monthly traded fund, okay, and you know, in a month anything can happen, and if there is a crash in the market or whatever, okay, 1 month can wipe out of performance. So we make sure that the funds we recommend are either daily or weekly. Okay, when it comes to bond funds, it's okay for it to be a weekly fund. Why? Because when it comes to bonds and equities, equities we need them to be daily, where bonds, if they're weekly, it's okay as well. Okay, but then again, make sure, and this is data you need to be asking. Okay, if you've come to the equity seminars, I kind of say that a lot of things, a lot of work needs to be done. And now I'm presenting a fund seminar with me as well. A lot of work needs to be done. But yes, at the end of the day, these are questions that you need to be asking. Okay, when you buy a fund, is the fund daily? Okay, if you're picking it from our list, I can tell you from now that they are all daily funds. But if you're picking out the fund by yourself, okay, make sure that the fund is daily or at least weekly. Something else which I need to mention is the cutoff time, because a lot of people ask, look, but you're telling me it's a daily fund, I put in the order and it wasn't traded the day, it was traded the next day and the markets fell. Okay, why did this happen? And the reason for that is that there is a cutoff time. Why? Because, like I said before, the administrator issues the price of the fund. Okay, and the administrator is an employee that goes to work, okay, and like our funds, he has many funds that needs to issue a price for. Okay, so normally this is what is known as a cutoff time. Okay, let's say the cutoff time is midday. So all orders to be included in the price of that day need to be raised before noon. Okay, so again, another question you need to be asking your advisor is what is the cutoff time of the fund? Okay, in order to trade on that day. If the cutoff time is noon, make sure you just raise the order by noon. Okay. And if you know these, it will make your life much more easier. It will make the life of the investment advisor much more easier. Something else, during the break, there are investment advisors in the room, okay, that have a blue tag. Do speak to them, okay, and do get to know what they're thinking also about the markets and what they also recommend. Why? Because it's important to talk, especially in this industry. The more you talk to people, the more you get to know what they're thinking, the better and the more informed decision you will be taking. What is the risk profile of a typical for a person to be investing in a fund? Now, who invests in a fund? Number one, if the amount of cash in your portfolio is not large, okay, it makes sense to invest in a fund. Why? Because, let me give you an example. If you have 10,000 euro, does it make sense to diversify your portfolio with 10,000 euro? Number one, you have to buy a lot of different stocks and different bonds, and 10,000 euro is a small amount. Okay, whereas if you get that amount, okay, 10,000 euro, 50,000 euro, and put it in a fund, okay, you're instantly diversified, okay, and you don't have to stay worrying, and you don't have the cost of, say, going into many different stocks, okay? So that's very important. Another thing is that if you don't have the knowledge on the markets, through a fund, you'll have a manager that's actually managing the money for you. Okay, so then again, like I said before in the very beginning, it's okay not knowing, not having an expertise, for example, on the equity market, but I feel comfortable with the bond market. Okay, so you do the bonds by yourself, but it doesn't mean just because I don't understand the equity market, I shouldn't benefit from the growth we're seeing. Give the responsibility to the fund manager if you don't like his performance, okay? Move on to another fund that has had positive performance. But something which is also important to understand, okay? It's useless saying, look, I bought this fund, but this manager is not performing. Look, I've seen the performances year to date, okay, and they always have been good. The manager always outperformed the market, but I'm losing on this fund. Entry into the fund is also important, okay? So again, like when you buy a bond, okay, you want to get it at a good price. Like when you buy an equity, you want to get it at a good price. It's the same with the fund. Okay, so if you're buying at peaks of markets, if markets trade 30% and you're buying at the peak, okay, I wouldn't be surprised if there would be some correction in the market and in the fund. Okay, so timing into a fund is also important. The fund manager does allocate in and out of cash, okay, so he can reduce the impact of what happens in the market, but if the strategy is, again, for example, a US equity strategy, and US equities are falling, the fund manager cannot go 100% to cash, okay, he needs to be invested in US equities. Why? Because that is his mandate. Don't forget that if you have, for example, if you're buying a US dollar fund, okay, and the fund manager does not go into cash, but is invested in US equities because that is his mandate, don't forget, when you're putting that portfolio into that fund into your portfolio, that is a mix of other funds, okay, that is a strategy that's part of a larger strategy. Okay, so he cannot go 100% to cash. Why? Because that's not his mandate. It's you that has to regulate in your portfolio, okay, what should be invested in bonds, what should be in equities when it comes to funds. If you can't do that by yourself, then there are what are known as balanced funds. And balanced funds include both equities and both bonds. Okay, so there's a mix of everything. There are funds for everything. Okay, when I did the equity seminar, like I said, there are equities for everyone. When we're talking about funds, even more, there are funds for everyone, okay? Because the funds go into different asset classes, not just one asset class, but they go into they go into bonds, they go into equities, okay? Then they go into many other things. Now we move on to the pros and cons, the advantages and disadvantages of investing in a fund. Number one, okay, it reduces the anxiety of investing. Okay, a lot of people tend to get anxious in the markets. Okay, last week we had a correction in the technology sector. Why? Because Goldman Sachs came out saying that, for example, tech stocks are overvalued, and in 2 days, for example, Apple lost 6% of its value. We, as KIID, saw that as a good entry opportunity, and we actually were buying for our fund. A lot of people get anxious, okay? The markets are volatile, okay? At the moment, volatility is actually low, okay? But there will come a time when the markets are volatile. If you just look back at last year, okay, we had Brexit, we had Trump, we had the Asian crisis at the beginning of the year. Markets are very volatile, okay? Yet they still manage to give decent returns to shareholders, but a lot of people can't handle that volatility. That anxiety, okay? What's going to happen? What's going to happen if, for example, Macron wasn't elected as president of France? Okay, this anxiety, people can't handle that. And if you can't handle that, okay, pass it on to someone that can. And what's great about a fund is that a fund manager doesn't think, look, should I keep on holding this stock or this bond? Maybe one day it will come back. No, if the fund manager thinks this bond is not going anywhere, it's going to sell it out of his portfolio. Whereas if you look at your own personal portfolios, I'm certain that most of you hold losers in your portfolio because you hope that one day they will come back. Okay, and as fund managers, we don't hope, but we make calculated decisions and we decide whether they should be there or not. If they shouldn't be there, we just move on. okay? Whereas you keep on holding and keep on hoping that one day these assets will come back. Whereas if you shifted out of those assets and put them into something else, today with the markets having rallied the way they have, you would have got most of them back. Okay, again, second point, they are professionally managed, okay, so the person taking care of the portfolio has a good track record. Some people say, but for example, the fund hasn't performed as good as the index, okay? But I say, even if the fund doesn't perform as good as an index, the fact that there was a manager there taking a decision, okay, rather than putting it into something that there's no one taking care of anything, okay, and was prudent in a situation where it was good to be prudent of, maybe, okay, the fund didn't give you 10% as much as the index, but it gave you 8%. But at least there was someone taking a decision, okay, even though it didn't perform as good as the index. For me, I would feel even more comfortable, again, knowing that someone has taken the decision. Okay, instant diversification. A lot of people don't diversify in their portfolio, okay. Just the other week, I met a client and he told me, I want you to take care of my portfolio, but I don't want to take any risk, okay? And I want a decent return. Okay, and the first thing I told him obviously was, can I have a look at your portfolio? And when I looked at his portfolio, the only thing he had in his portfolio, okay, which was a huge amount, was just Apple, okay? So all his assets were in Apple. I told him, but the first thing he told me was, you don't want risk and you just have Apple? He told me, because I understand the company, I understand the industry, and just by saying that, I understood that this person doesn't really understand anything. Because you can't come and tell me that I don't want to take risk, and I look at your portfolio, and you just have one company, because you feel that it's the greatest thing on earth to be holding. Well, so even though you think it's the greatest thing in the world, you cannot be 100% vested in one stock, okay? So, reinvestment of income. If we're talking about a bond fund or an equity fund, okay, the income which is received from bonds within the portfolio or from equities, okay, that cash is reinvested. Okay, so again, income, dividends that we get from the equities or income that we get from the bonds, okay, that is yours. Okay, you are the owners of the fund, you are the shareholders of the fund, sorry, and you get that income. We don't distribute it. Okay. If the fund does pay dividends, it will pay it out at a later stage, but the dividends we get from individual companies are reinvested in the fund, okay? Again, effective for smaller amounts of money, okay? So again, you can easily get diversified with smaller amount of money and get exposure to sectors which you do not know about, okay? And something which many of you, I'm sure, do not know, but for example, we have a European equity fund, and all the dividends we get from the companies we invest in, okay, we recoup the tax, okay? So we don't even pay tax on the dividends we pay. Whereas as you know, you pay tax, your tax is automatically deducted when you get dividends on these companies. Again, an advantage when we're talking about funds. Then we have to look at the disadvantages of funds, okay? And in fact, I just wrote one, and my boss told me to write more because you cannot just write one disadvantage. But the actual fact is I try to fill in the gap because I can't really think of many disadvantages when it comes about funds. And when I even read them, for example, management fee, obviously there's a management fee when it comes to a fund. But what do you expect? Someone's managing the portfolio, you need to be paying the management fee. And again, if it's a daily fund or a weekly fund, you need to know when the cutoff time is, and just like an individual bond or equity, you can't sell instantaneously, okay, but you have to wait for the NAV to come up, okay? But then again, if you look at the pros, if you look at the cons, okay, we can spend the whole day talking about them. There are much more positives about being invested in a fund rather than there are negatives. Okay, making an informed decision. Like I said, there are thousands of funds out there. There are many funds on our lists, okay? Even just by looking at our list, there are many funds. But even our lists are broken down, okay? There are high yield bond funds, there are investment grade bond funds, there are equity funds. It depends on the outlook of the market. So it's not just any fund I buy because it's on the list, okay? It's going to outperform. The strategy has to make sense. There are, like I said, you need to be speaking to your advisors to get advice. Okay, if not your advisors, people that are knowledgeable on the subject. And something which is very important, the documents which you need to know that exist. Okay, and these documents, the KIID document, the fact sheet, and other documents which I'll go into in the next slide are very important that you know about them. Okay, now I'm not telling you get a book and read it because I'll show you how to do it the easy way. But even knowing that there are these documents out there, you'll instantaneously know, okay, the risk of the fund, okay, the past performance of the fund, what the fund manager is thinking, is it in line with what you are thinking, okay? And through these documents, you get to know this, okay? We've just been through the first few slides of the seminar, and you already know that these funds are very transparent, okay? A lot of people, whereas you think it's a black box, or if you thought it was a black box, I hope that you're starting to convince yourself that everything is transparent and every question you ask can be answered, okay? Again, we have our own in-house research, and like I said, something which is a positive for Kalamata Kushkiri, we always say what we think, okay? So if you look at the Times of Malta on a daily basis, someone is writing an article, okay? And we say what we think about the markets or about an individual stock or a bond, okay? But we're giving our advice, okay? Now, it's up to you to take that advice and see if you agree or disagree, but it's important that you continue reading and you continue debating on where you think the markets are going to go. But information is out there, okay? A lot of information is also put on CC Trader, okay? For our clients, on a weekly basis, we send the lists which are in your pack to you via email. So if you do not have an email registered with us, make sure you get your email, you give your email to your advisor, or leave your email with the receptionist before you leave the room, and you'll be getting these lists and you'll be getting what we think about the markets, okay? So it's important that you are informed about the markets and you keep on keeping yourself informed so your portfolio continues to generate positive returns. Documents available to shareholders. Now, these documents are very important. Why? Because like I said, it gives you a better understanding of what the fund is actually doing, okay? Of what the fund manager thinks, of how risky the fund is. And I'll skip the first two. Why? Because they are heavy documents. I'm sure that most of you won't even go through them, okay? Or if you go through them, you just say, I don't even want to buy the fund because it's complicated. So I'm going to try and break it down for you and make it easy. I'm going to summarize all of that, those big documents, and go to those documents, those 2-page documents, okay, that they're just 2 pages, but they give you all the information you need, okay? And that is the KIID, the Key Investment Information Document, and the fact sheet, okay? So let's start off with the KIID. Now, this document is issued on a yearly basis, could be issued more than once a year if things change within the fund, okay? But on a normal circumstances, it comes out once a year, okay? And what does this KIID tell you, okay? It gives you, number one, the investment objective of the fund, okay? So you know immediately, okay, what the objective of the investment manager is. 2, it tells you what the risk of the fund is, okay, which is known as the SRI, okay? Now, by looking at the SRI, okay, which is a complicated mathematical equation which determines the risk of the fund based on past performance of the fund. Okay, so it's not what the investment manager doesn't wake up one morning and say, look, let me put a 4 because no, that amount, okay, is worked out through a mathematical model based on past performance, okay, and we get how risky this fund is, okay. In this case, it's rated as 4. So we could say that 4 is medium risk. Why? If you move closer towards 1, it's much less risky, okay, portfolio. If we move towards 7, obviously, it means the risk in the fund is increasing. Okay, so there. A lot of people say, but how risky is this fund? I'm going into a fund, I don't know what risk I'm taking. Looking at the SRI on the KIID, you immediately know, okay, what type of risk you'll be expecting. So it's useless buying a fund with an SRI of 7, okay, and then saying, markets are very volatile, something happened, okay, and my fund is down 20%, okay, for example. I thought, you need to know the risk you're taking in your portfolio, like anything else in life, okay, whatever you do, you need to know what you're doing. And this is when it comes to a fund, okay, you need to know the risk you're taking. So again, if you're buying a fund, if you don't want risk, if you, like that client that told me I don't want any risk, and he buys a fund with an SRI of 7, that would be total madness. Okay, so he should be looking at something towards 2 or 3 if he doesn't want any risk. Whereas on the other hand, if he's willing to take risk, okay, if the investment objective is in line with what he believes in, then yes, okay, go ahead and take on high risk. But it's an informed decision. Okay, there's no hidden numbers here. It's available for everyone. And then there's the past performance. Now in this case, it's just showing 1 year, full year performance. Okay, actually 2 years. And the reason for that is because this was a newly launched fund. And I actually put this fund, used the KIID of this particular fund. Why? Because this is an equity fund that pays out interest, pays out dividends to shareholders. Okay, so if you want an equity fund and you want income from that equity fund, okay, this is a UBS fund that actually gives distributes this income to its shareholders. Okay, so again, something else which is interesting for you to know is that when we produce the results over there, okay, on the KIID, they need to be for a total period of 12 months. Okay, so if the fund was in existence for less than 12 months, performance cannot be shown there. Okay, so that always is for 12 months. You cannot look at it and say, but the fund is up 6%, but that's just for 4 months. And that's showing for 2016. No, that's not correct. Okay, that's always for 12 months. Now, I haven't started explaining the structure of the funds we will buy at Kalamat Kushkiri and the structure of the funds we offer our clients, okay? But these documents are available for all the funds and are all in the same format, okay? The only thing that's changed is the company name at the top, okay? And then I'll explain why they're all the same, okay? In another slide. Now, again, on the KIID, we're still on this 2-page document that's giving you all the information you need to know, okay? We move on to charges, okay? There's what is known as the entry charge. Now, over there it's showing us 3%, okay? That's the highest amount that could be paid, okay? We're talking about a UBS fund, okay? This is a fund that could be purchased at Kalamat Kushkiri, and I can tell you that 3% will be actually lower than 3%, okay? Something else I need to tell you is that since we're working with UBS now, in the coming weeks, in the coming week actually, we will be officially launching our UBS list, okay, and we'll give further discounts on that, okay. So don't give too much weighting, for example, on that 3%. Plus, that's for this specific fund. That changes for different funds, okay. But that's the maximum that can be paid, okay. But something I need to point out is, because people talk about fees, hidden fees, and funds, like I said, everything is transparent, and I'll explain to you how it works, okay? This is the thing which is most important and you need to look at, okay? The ongoing charges. In this case, it's 1.87% for this particular fund, okay? And what is that telling you? We talk about the management fee, okay? We talk about someone issuing the NAV of the fund. Okay, we talk about the custodian. These people need to be paid. Okay, so how much fees are there? Okay, what is the burden of the cost on the shareholder buying the fund? And the burden of the cost is actually 1.87%. Okay, and that's not a fee you pay. Okay, when they work out the NAV, when they work out the price of the fund, that's already deducted, included in the NAV. Okay, so the only fee you pay when you buy a fund, okay, is in this case would be the entry fee, okay, which is paid once, because when you sell the fund you don't pay anything, and there's no exit fee. But those other fees, for example, we talk about the management fee. So you say there's an entry fee, there's a management fee. No, the management fee is already deducted in the NAV, okay. So when you get your statement, because you bought a fund, you don't get, look, there's the entry fee, but and then look, there's the management fee, there's the custody fee. There's just, okay, those other fees, the management fee and other, are all included in the NAV. So you buy that price and you sell at a price, everything is included there, okay? So that 1.87% for this particular fund includes everything. Okay, the fact sheet. Now, again, I said there are 2 very important documents you need to be looking at. Okay, one is the KIID and the next one is the fact sheet. Now, the KIID comes out once every year, I told you, but the fact sheet comes out every month, okay? As you know, fund managers report their performance every month, and they do so through the fact sheet. Now, this is extremely important document. Why? Number one, most importantly, because you know how the fund has performed throughout that month. Okay, and you can see that through the chart. Two, it gives you a fund description. Okay, but the fund description you would have already got that from the KIID. Okay, so something which won't be in the KIID is obviously the monthly performance. But most importantly are the slides ahead. Okay, this gives you the type of fund it is. So number one, you get to know what the ISIN of the fund, and the ticker of the fund. Okay, so when you're looking for the fund on the internet to get further detail on this fund, okay, there's what is known as the ticker. You know, in this case, that this share class is USD. Now, something else you need to appreciate is that there are many funds. You can have a fund, okay, with different share classes. Okay, so you can have a fund that has a euro share class, or can have a dollar share class. Okay, in this case, this is a US dollar share class. Okay, so in this case, if you're looking at this fact sheet, it means that this fund is in US dollars. Okay, and it is an open-ended fund. Okay, so you're going through them, and you see their fund type, open-ended. What does open-ended mean? Okay, it means that if someone is going to buy into a fund, okay, the administrator, okay, when he calculates the NAV of the fund, will issue more shares. If there had to be a closed-ended fund up there, what does that mean? It means that the fund is not issuing any more shares. Okay, in that case, it would mean that the fund trades on an exchange, and the price could be higher or lower than the NAV. Okay, we buy open-ended funds. Okay, and the price reflects exactly the value of the company at NAV level. Okay, but just in case you look at a sheet and you see closed-ended fund up over there, closed-ended, that means, okay, that new shares are not being issued, and the fund is being traded on an exchange. Something we said which is very important, okay, is daily. How regularly does this fund trade? Again, like I said, we stress daily. This is a fund of UBS, and we said the funds that trade daily are important. We need them to be daily, or at least weekly, okay? And this is daily, okay? And down here, again, in the fact sheet, you have the total expense ratio. So what am I paying, okay, for this fund? Again, you're not paying it up front, you're not paying it at the end, it's just being deducted, okay, in the NAV, okay? And costs, obviously, I'm going to use a heavy word, costs are accrued. It means that they are divided, okay, throughout the year. Obviously, costs are not just plugged in at the end of the year. Imagine you bought a fund at the beginning of the year, you sold after 3 months, okay? And someone kept on holding till the end of the year, and all costs are attributed at the end of the year. It doesn't work like that, because obviously it doesn't make sense. So costs are divided, okay, throughout the year, so it's fair for everyone, and when you come to sell the fund, okay, or when you see the pricing of the fund, it's fair for everyone, okay? Again, something else which I think it's important to understand, you're looking at the fact sheet here, you see management fee 1.4, total expense 1.86. That doesn't mean you're paying 1.4 and 1.86, okay? Forget the 1.4, that's just telling you what the management fee, okay, is. The total expense ratio being deducted is the 1.86, okay, which includes the 1.44. Okay? Then here we see the performance of the fund, and like I said, the performance of the fund is being shown compared to that of an index. And the first thing you can say here is, for example, look, there were years when the fund underperformed the index. But the reason for that is that the fund manager in this case, and in this type of fund, this is a defensive, although it's an equity fund, okay, it's a defensive type of fund. Okay, so the fund manager prefers not taking risk if he has an outlook on the market, okay, that is still bullish, but he still believes that capital preservation is more important, okay, than capital gain. But even look at the performance of the fund, okay? In 1 year, 12.16%, in 2 years, 11%, 3 years, 17%, okay? Not as high as the index maybe, but still, like I said, there was a manager there and the manager was prudent. Okay, you know what we went through in the previous years. Okay, who would have blamed the manager for preserving capital, okay, and not being over bullish, okay? Who would have guessed that immediately after Brexit, when the markets were down 15% in one day, the market would have rallied so strong, okay, and then 2 days would have caught back most of those losses, okay? It would have been imprudent for a manager to immediately tap the market, okay, go in the market. So you need to understand and appreciate, okay, what were behind the figures, because it's usually just pointing your finger and saying, look, but he didn't perform as good as the benchmark, so this is not a good fund, okay? You have to understand why things happen. And I'll show you in another slide, in the next slide, okay, exactly what the fund manager is thinking today, okay, and how you can look at the fact sheet and understand what the fund manager is thinking about the markets, okay? In fact, over here, I told you that the fund manager was less risky than the market. In fact, if you look down here, okay, at the beta of 3 years is 0.66. Okay, the market has a beta of 1. Okay, in simple terms, risk is measured through beta. Okay, so if a market has a beta of 1 and this fund has a beta of 0.66 on a 3-year average, okay, it means this fund is much less risky than the market. So it's obviously, it's common sense that if the markets went up very strongly, okay, this fund is going to go up less strongly than the markets, okay, but the fund manager was prudent. Okay, again, a lot of detail on just one sheet, okay, but a lot of things for you to understand. The NAV over there, I was talking about the price of the fund. There it is at the end of the month. At the end of the month, it's reported on, obviously, if it's a daily fund, it's available every day, but this is reported every month. So there you go, you have the NAV of the fund there. The highest price, you know, if we're talking about an equity and you go on Google Finance or on CC Web Trader, you see the high price for the year, the low price for the year. Again, this is giving you the highest price and the lowest price of this particular fund, okay? And somewhere there is also the distribution of the fund. Okay, so here, indicative current equity yield, that's 7.5%, okay? That's an excellent dividend yield, okay? Again, you have an equity fund, you have a dividend yield, it ticks most of your boxes, okay? Now, again, obviously, like I said, this is 2 pages. I just snipped parts of the fact sheet in order to make it more visible for you, but these are all on 2 pages, okay? Now, I said that, actually, come over here. I said that from the fact sheet, you can gauge or you can understand what, during that month, and if it's at the end of the month, this is data coming out at the end of the month, so it means his position for the next month, okay? What the fund manager is thinking. And it's interesting here to understand, look, financials, he is overweight on financials, okay? We are actually overweight on financials, whether it's in the US or in Europe. Why? Because we're in a situation where in the US interest rates are rising, and in Europe we expect interest rates to rise sooner than later. If interest rates start rising in Europe, banking stocks will benefit from that, okay? And banking stocks, not in the US have done extremely well, but in Europe, this year, they have done well last year, but this year have lagged so far the index, and we expect them to recover in the months ahead, okay? So again, we're in line with what UBS are saying here when they're overweight on stocks. They actually reduced, okay, deviation from the index, they reduced, so they're underweight technology stocks when compared to the index. What does that tell you? Okay, it doesn't mean that UBS, in this particular fund, the fund manager doesn't like tech stocks. The fund manager, just saying that, is telling me that tech stocks in the short term for him are overvalued, okay? So he reduced his exposure to the index, okay? And even if you look at the next one, the healthcare, consumer staples, and telecommunications, he's overweight there. So what does that tell you? Okay, these are defensive stocks. He's overweight on defensive stocks, so at this point in time, this fund manager is defensively positioned. Whether you agree or disagree is debatable. I'm just telling you how to interpret what the fact sheet is telling you. Okay, because again, you don't just look at it and say performance is 2% for the month, very good, and you move on. Okay, no, That doesn't mean I think that's the past, okay? You have to understand what the fund manager is thinking of the future and whether you agree or not, okay? Because if you disagree with what he's saying here, okay, then maybe you need to find another fund that invests in where you think the market should be going, okay? But just looking at that, a lot of that makes sense. Again, just because he's underweight technology is not telling you that he doesn't believe that the technology sector is a great sector to be in. He's just saying you that in the immediate short term, okay, he thinks he can get alpha, he can get excess returns from other sectors. Okay, so again, don't just interpret a figure by saying, this guy doesn't want to touch tech stocks anymore, so I shouldn't be touching tech stocks. In fact, being underweight the index doesn't mean not holding any tech stocks. It means holding less tech stocks than the index. Okay, because again, the jargon in the industry says overweight or underweight. Overweight means holding more than the index. Underweight means holding less than the index. Does not mean does not hold. Okay. In fact, if you see underweight, it doesn't mean sell. It means hold less than the index. Why? Because when you position your portfolio and your portfolio is well diversified, okay, you have a number of stocks, okay, and you'll be tracking it by using an index, okay, and the proper way it should be done, okay, there will be those stocks which you think will outperform, you go overweight, so you hold more. For example, I look at, for example, a tech ETF, okay, let's say, I think tech is going to do extremely well, and I hold a tech ETF, okay? And if I'm not mistaken, if you look at TNO, which is an ETF in tech, there's about a 30% exposure to Apple, okay? In that case, if you think Apple is going to do extremely well, you'd have, for example, 35% exposure to Apple, because you're overweight the index. Where there, if you think Apple is not going to do so well, okay, you'll be underweight Apple, so you'll hold, for example, 10% Apple. Okay, it doesn't mean you don't hold Apple, you hold less. And that's what the investment manager is telling you here. Okay? And here, he's telling you, okay, from a country exposure, what the investment manager is telling you. And here, he is underweight the US. Okay, he holds less in the US. Again, this is in line with what we're thinking at Kalamata Kiri. He's not telling you that the US is not going to perform. Okay, he's telling you that there are other countries that will outperform in the short to medium term, okay? And just by looking at what he's saying, we're pretty in line. Why? Because what he's saying is that the outperformance is going to come from emerging markets, okay? And we too think that emerging markets going forward should continue gaining ground. Okay, so again, so much data, okay, in just a 2-page document. One, just to quickly brief up, put everything into perspective, the KIID is telling you how risky the fund is, okay? And the fact sheet is telling you, okay, performance-wise, how the fund is doing, what the fund manager is thinking, and how he's positioned. So there, in just 4 pages, okay, 2 from the KIID and 2 from the fact sheet, you have everything you need to know, okay, without having the need to go through a lot of documents, heavy documents, and feeling you can't keep up with so much documentation. Okay, and then one last slide giving you the key benefits of the fund and the risks of the fund. Okay. Time horizon, buying a fund. For how long should your time horizon be? Now, like we say, for whatever we're buying, okay, we take a stance. And ideally, that stance, okay, the way the portfolio is positioned for a 5-year period. Obviously, during those 5-year periods, things change. Okay, so it doesn't mean today we're saying this. You position your portfolio and you keep it for 5 years. No, because why? Things will change, and you need to adjust your portfolio in the interim. Okay, but when you start off your portfolio, okay, you need to have a 5-year view. And why am I saying this? Because you don't buy a fund to trade it. Okay, it doesn't make sense to buy a fund to trade. If you want to trade, buy a stock. Why? Because buy a stock or a bond. Because fees are less. For trading purposes, you trade for lower amounts. Okay, so it makes sense to trade individual stocks. But when we're talking about a fund, okay, it's for a long-term view. Okay, so again, if you want to trade the market, okay, buy individual stocks. Just the other day, I met a person and I was trying to convince him on putting his money into funds, and this individual had a portfolio of 1.3 million. Okay, and when I looked at his portfolio, I couldn't understand what he was thinking, okay, because his portfolio was all over the place. I told him, but you need to structure your portfolio, okay, especially today that the markets are where they are today, okay? And he told me yes, but I like playing around. I told him, yes, but you don't play around with 1.3 million. You structure your portfolio if you want. Go buy a ball or something and play around with that. But with 1.3 million, well, even if it's 10,000 euro, because at the end of the day, it's subjective to the individual. But you don't play. I mean, and something else which is important to understand, which he told me was, but I understand the markets, okay? And once someone tells me I understand the markets, I already, because even us that are in the field sometimes find it hard to interpret the markets. But anyway, and I told him, what do you do then? He told me, I go on Google Finance, I find price target. If the price is higher, I buy the stock. Okay, where this worried me even more on the way he's actually managing his portfolio. Talking about price target, since I just mentioned it, okay, if you're reading our research reports, if you're looking at our price targets, okay, a lot of work is being put in to come up with those price targets, okay, and we show those price targets for our clients, which are you. Okay, if you go on the internet and you just pick up a price target, if you don't understand the reasoning how this price target has come about, okay, rest assured that if the price target came out by JP Morgan would have already sold all the stocks he needs to sell to his clients, and you would be the last one going in and just pushing up his price. Okay, so don't just go on the internet and just pick up things. Okay, you have to understand where things are coming from, even if you get it from a CC equity list. Okay, it would be good to ask. Okay, why is this price target where it is? Okay, that's why there are the advisors to talk to, and that's why there's CC Trader, where we upload continuously data and information on what we believe an investor should position. Okay, funds as part of investment portfolio. And again, this is just a summary basically of how much should be invested in funds, okay, and who should be invested in funds. So the smaller the size of the portfolio, the more you need to be allocated to funds. Okay, and again, different types of funds out there. I spoke about equity funds, bond funds, and I mentioned balanced funds, which is a mix of bonds and equities. Okay, again, helps you even further. Okay, maybe you are a bond person. Okay, you've seen the equity markets do well, and we're saying that equity markets will continue doing well, but you still you're tempted, but you don't want to go in it 100%. So you can start off by buying a balanced fund. Okay, we actually offer a balanced fund in-house because we have our CC balanced fund. Okay, money markets funds, like I said before, I explained what they are, but there's no making money there at this point in time. Then there are specialty funds that go into, for example, commodities. There are fund of funds and hedge funds. What are fund of funds? It's a fund that invests in other funds. Now you say, why would I want to buy a fund that invests in other funds? At the end of the day, all you should care about is the bottom line. Okay, how much money are you making? Okay, if the funds are giving you a return, okay, and that return is satisfactory, all you should care about is the return you're getting. I don't care what the fund invests in, as long as the fund gives me the return I'm investing in. Okay, so it doesn't make any sense saying, because the fund is investing in another fund, it's not going to individual equities. What is that actually telling you? Because at the end of the day, the fund manager is taking an informed decision on where he thinks the markets are going. So whether it's the fund manager invests in ETFs, whether he invests in direct equities, whether he invests in direct bonds, whether he invests in other funds, all you should care about is how much money you're making. Okay? And then there are the riskiest of all, and we don't even offer them on our list, obviously, hedge funds. And hedge funds are different from the funds we offer on our list. I didn't start yet by explaining the type of funds we have, because the funds we offer are known as UCITS funds. Okay, and I'll explain that later. I don't want to go into that now, but just to show you that UCITS funds are regulated and hedge funds are not. Okay, if, for example, like that investor, I have a portfolio, okay, and let's say of $500,000 and they put $500,000 in Apple, okay, a hedge fund can do that. A UCITS fund cannot do that. Why? Because there are limits on the investment advisor. He cannot do whatever he wants, okay, and just by saying that, put your mind at rest that the investment manager cannot do whatever he wants, okay. Then there are what are known as exchange traded funds. When we're in the equity seminar, I mentioned them a lot, okay, because if you do not have the expertise on an individual stock but want to participate in the industry, you can do so through exchange traded funds, okay. And what are the difference between the two? In a fund, you have a fund manager that's taking care of your portfolio. In exchange traded funds, there's no fund manager. Obviously, fees are more expensive for the fund than for the ETF, okay. But what worries me about an ETF and not about a fund, okay, is that an ETF, the basket is ready. Okay, they don't saying, look, okay, we're moving towards the end of the month, okay, end of June, ends another quarter, ends the first half, we'll kick off earnings season, okay, which are the equities that are going to outperform. The fund manager will be discussing that, okay. The ETF, there's no one discussing anything, okay, so it's just that basket, okay. I still think ETFs are a great investment tool, but you don't have the expertise of the manager, okay. So if you want, again, someone taking care of your portfolio, okay, someone deciding where it should be invested. In our own funds, we invest in ETFs. Why? Because we take a macro view. If we think for example, auto sector is doing well, we have our top picks, okay, for example, like Renault, like Daimler, but we think overall the industry is doing well, then we buy an ETF in the fund. But the fund manager, like I said, if it's for an individual client, even just knowing that there's someone there, okay, worrying about my money, okay, puts my mind at rest. Okay, and now we move on to the funds we have in our fund list, okay, what they are, okay, and I spoke about UCITS funds, okay, and UCITS funds are the exact opposite of hedge funds, okay. Now, again, it's useless comparing the performance of a hedge fund to a UCITS fund, okay, in, let's say, a bullish market, because there's a probability that the hedge funds will do well. Why? Because the hedge fund can take all the risk he wants, and the hands of the investment manager in a UCITS fund, okay, is more contained, okay. But then think of when things go sour. Think of when we had Brexit. The next day, markets were down 13%. Okay, I would shudder to think the performance of a hedge fund would be compared to that of a UCITS fund. Okay, at the end of the day, all we care about is that the funds we manage, we know exactly what's in them. Okay, I talked about KIIDs. Okay, those are available for a UCITS fund. Okay, it could be maybe another fund comes up with a KIID, but they don't have to produce. KIIDs are produced for UCITS fund. Okay, and by UCITS fund, how did they come about and what does it mean? Okay, we are in the European Union. Okay, and for example, there are the UBS funds, okay, and there are the KIID funds, okay, and we want a level playing field, okay. We have the MFSA, they have their own regulator, okay, but we want a situation where everyone has, I don't want to buy a fund not knowing that exactly what's happening and what is happening there, okay, and this is how UCITS came about, okay, so it's a level playing field, okay, exactly, okay, what the rules that state for KIID funds are the same for UBS funds. Okay, so the difference is obviously the fund manager's decision being taken and the custodian, whatever, but everything else is the same on a level playing field. Okay, so one fund is not advantaged over another fund because the regulator gives him more flexibility. Okay, or he can take on more risk. Risk is, or in what he can, the limitations are the same for both. Okay, and just to give you an understanding, okay, of the fact that, again, a question that a lot of people ask, okay, but the fund manager can do what he wants. What if he takes on too much risk in my portfolio? One, you have the KIID. Two, there are the limitations on the fund manager. For example, if I think Apple is the greatest stock on earth, okay, and I want to buy it because it's hugely undervalued, okay, I cannot buy 80% of my portfolio, 100% of my portfolio like that individual did with his portfolio. Okay, I can buy up to 5%. I can increase that up to 10% as long as my holdings between 5 and 10% don't exceed 40% of the value of my portfolio. Okay, again, that should put your mind at rest that, look, the fund manager cannot take excessive risk on an individual stock. The most he can push up to is 10%. Okay, so there are situations, or there were funds in the past that did go bust just because of one stock. Okay, they had a huge gut feeling that a company, for example, is going to do extremely well. If this company did extremely well, the fund will do extremely well. Okay, but the fund, this company, for example, didn't do well. It actually defaulted, and the fund ended. This can never happen with a UCITS fund. Okay, because there are rules. Okay, for example, basic rules, but even to this detail, UCITS fund go into, for example, a 20% exposure to any credit institution. So, for example, we have an equity fund, okay, and we have obviously cash in the portfolio. That cash is being held, okay, by a credit institution. I cannot hold more than 20% of the value of the fund at that credit institution. Why? Because if something had to happen to the bank, okay, I diversify even when it comes to cash. Okay, so I mean, maybe for some it will be excessive, but it's just showing you that everything is in the best interest of the client, okay, and everything that's being done is there's a lot of thought in every process, okay. Just for example, if a fund holds sovereign bonds, okay, there's a 35% exposure to a member state. For example, I don't know, take Italy for example. There could be opportunity there when it comes to sovereign bonds, but still, it doesn't mean going all out on Italy. He can't even do the investment manager because there are these limits. Okay, then there are risk limits, and there are also what is known as asset eligibility tests. Okay, even when we come to buy an individual stock, okay, I need to go through a process that making sure the stock is liquid, and all those processes, and everything is documented. Okay, so again, every step or every decision a fund manager takes, okay, he needs to abide by these rules. Okay, so again, now the fund manager has a lot of rules, okay, he needs to abide by. But who makes sure these rules are being in place? Because, I mean, I can say a lot of things, but then I can do whatever I want. But who makes sure that the fund manager is working in line with what he should be? Okay, and first of all, that for our own funds, for example, there are 2 managers on each fund. Okay, each fund is co-managed. For the reason of that, when one fund manager is not there, there's the other one, plus there's continuation. Okay, there is a 4-right principle. Okay, even when we come to place a trade, for example, the other manager makes sure that everything's in line. When we check the risks, for example, when we check the exposure, the 5-10-40 rule, one manager countersigns the other manager to make sure that everything is in line. Okay, again, everything in the best interest of shareholders. Then there is what is known as the risk manager. On a periodic basis, the risk manager checks the checks of the investment manager to make sure that everything is in line. Then there's the custodian that checks the investment manager. Okay, so there's so many checks in place, okay, that the fund manager, okay, is always in line with the limits. And if the fund manager is not in line with the limits, it is the obligation of the risk manager to go to the MFSA and report the fund manager, or the custodian to go to report the fund manager that he is not in line with limits. Okay, so the fund manager has to be in line with limits. Okay, there's no way, if maybe one of your questions would have been, but there are the limits, but at the end of the day, who knows what he's doing? There are all these people monitoring, okay, the fund, and monitoring that everything is in line with the limits. Okay, now we're talking about the price of the fund, the NAV. Okay, we buy a stock, we buy a bond, we talk about a price, we talk about a fund, we talk about the NAV. Okay, known as the net asset value. Now, all you need to know about NAV and what it means, okay, it's the portfolio of the manager. Okay, all those stocks, all those bonds, everything he holds, the value of all that together. Okay, but it's not just that. From that, we deduct, okay, the fund administration deducts the fees okay, on a daily basis of the fund, okay, and adds back any prepaid expenses which were paid. Okay, again, maybe it's a bit complicated, but it is the price that you are paying when you buy a fund. Now, something which you need to keep in mind, if, for example, a fund trades at 100 or whatever it trades at, the price is irrelevant to a certain extent. Okay, this is not a bond. Even if it's a bond, it's at an extent irrelevant. Why? Because when we talk about a bond, you should be looking at the yield, not at the price. But that's another debate. Okay, but just to put it in the picture, the price can be 100, the price can be 1, the price can be 1,000. Whatever the price is, that's not important. What's important is the outlook and the return you expect to be getting from this fund going forward. Okay, so if the fund is trading at 101, this is not a bond. We don't say this has nothing to do with the way you should be looking at bonds, but I know a lot of clients look at it that way, so I'm just comparing. If it's trading at 101, it doesn't mean you wait for it to be at 100 for it to be attractive. It has nothing to do with that, okay? It's just a price. Okay? And you times it by the amount of units. Okay? When we talk about a fund, you're given units. You are a shareholder in a fund. Okay? You're not giving a nominal value like you're giving in a bond. So, just to help you understand, if a fund is trading at 100 and you buy 1,000 units, okay? 100 times 1,000, that's the value you need to be paying. Okay? When you buy a bond, you buy nominal value, so it's 100 times 1,000 divided by 100. Okay? If, for example, I have 10,000 euro and the bond is trading at 100, okay, I have 10,000 nominal and I pay 10,000 euro for the bond. If it's a fund, it's more than 10,000 euro, 10,000 units times 100 euro. Okay, so that's a price, it's like an equity, okay? 100 euro times the units. Okay, with a bond you divide, with this you don't divide, you just have the units and the price. Do all funds pay out dividends to its shareholders? The answer to that is no. There are two share classes, okay? There's a distributor share class and there's an accumulator share class, okay? An accumulator share class doesn't pay out a dividend, it reinvests the dividend. Okay, now I'm not talking about the dividend received from the individual stocks, I'm talking about paying out a dividend to its shareholders, okay, which are you. The accumulator share class does not, the distributor share class does. Now, there are funds that have two share classes, a distributor and an accumulator. There are others that are just accumulator or that are just distributor. If you want income distribution, like that fund I mentioned before, where I showed the KIID, okay, that is a distributor share class, okay, that will pay out income to its shareholders, whether an accumulator does not. However, I'd like to stress the point that there is no actual difference between a distributor and an accumulator. Okay, this is exactly the same like when I'm explaining an equity and I'm saying an equity goes ex-div, whether an equity pays a dividend or not. It doesn't make a difference. A lot of people don't understand it. I explain it a million times. Many times you don't understand it, I'll explain it again. Whether it pays out a dividend, and I'll show it to you easily on this slide. Okay. This is the KIID bond funds. One of them is an accumulator, the other is the distributor. Maybe this time I said if I show it graphically, people will understand it better. The accumulator, the price kept on going up. If you see, till this point, the accumulator and the distributor share class traded exactly the same. Why? Because they are exactly the same. At one point, one of them, the distributor, paid the dividend, okay, the interest. So the price of the fund fell by the value of the interest paid, okay, and the price kept on moving in the same direction, okay, as the accumulator share class. At no point is that graph saying that the accumulator did better than the distributor, because there you are paid out the dividend, okay, so they're exactly the same. But one of them, you asked for a dividend, so it gave it to you through the distributor share class. The other one said, look, I don't need the distribution, I want that income to be reinvested in the fund, okay, and rather than distributed, and the price kept on going up.
What are the tax implications on that?
On the interest, that's 15% tax on when dividends are paid out. Interest is paid out on this one. You don't pay tax, obviously, because it's continued reinvesting. Okay, so actually, if you think about it, you're better off with an accumulator. Why? Because you don't pay the tax on the dividend. But people still continue asking for a dividend because they think they're better off with a dividend, with an interest. But in actual fact, it's the same thing. Okay? But again, I understand the concept, because if I'm a pensioner or if I depend on income coming from my portfolio, I need that income. Okay, so they get it through the distributor. But you need to appreciate that they are both the same. Okay, to summarize, what to look out for when we're investing in funds. Okay, and okay, the past performance of the fund. Okay, if over the last 5 years the fund has constantly generated positive returns. Okay, it's showing a trend. Okay, that the fund manager knows what he's doing. Okay, that the fund manager team remained the same. Okay, because if the fund manager is changing each year, then that data is not relevant anymore. Okay, what the fund is investing in, like I showed you in the fact sheet. Okay, the SRI, what is the risk of the fund? Okay, the fund manager's track record, and the fees of the fund are reasonable, and all this data is available for everyone. Okay, nothing is hidden. Okay, what percentage to expect from a fund? Now, obviously, not every fund is the same. Okay, it depends on what the fund is invested in. So if the fund is invested in equities, for example, European equities, and we think European equities are doing well, okay, and we think that over the next year, over the next 12 months, European equities should continue gaining ground, and we should see, for example, a 10% increase in the markets, okay, you could attribute that to an equity fund. On the other hand, if we're talking about the high yield market, for example, in Europe, and we're saying we're neutral on high yield in Europe, it's useless buying a high yield Euro fund and expecting a 10% capital gain in that. Why? Because it goes against what the house is saying. Okay, so it depends on the strategy of the fund. Okay, and obviously the skills of the investment manager, but the skills of the investment manager can be seen also through past performance of the fund. And if the SRI is higher, you expect higher returns. Obviously, the higher risk you're taking, the higher returns you expect to get. And the market environment, obviously, all ties in together. Okay, so the next part of the presentation is actually going into the individual names and how to start building your own portfolio. Okay, but before we do that, I think we could have a small break and continue after.